Welcome to this practical guide on refinancing a high-interest auto loan, even if your car is older than 10 years. If you're paying 17% or more and started with a mid-600s credit score, you're not alone. Many lenders enforce a 10-year cutoff that blocks borrowers from better rates, but it doesn't have to trap you. In this video, we will walk step-by-step through a strategy that pivots away from national lenders and toward local credit unions that weigh loan-to-value more than vehicle age. We will also cover how to calculate LTV, what documents to prepare, alternatives if a refinance is still out of reach, and pro tips to lower your rate faster. To ease in, let's begin with today's agenda so you know exactly what to expect, and then we'll move into the mechanics of why the industry's 10-year rule hurts consumers. Here is the roadmap for this video. First, we will define the problem and explain why national lenders commonly reject vehicles older than 10 years. Next, we will focus on the local and smaller credit union approach and why their policies can be more flexible. Then, we will calculate your loan-to-value so you can objectively assess your chances. After that, we will walk through a step-by-step plan you can follow this month. We will also cover backup alternatives if a traditional refinance is not yet possible. Finally, we will consolidate pro tips, share a sample timeline, and test your understanding with short quizzes. With the agenda set, let's transition into the core problem many borrowers face. The 10-year barrier is an underwriting shortcut used by many big banks and large online lenders. If your vehicle is older than 10 model years, they often auto-decline or refuse to offer competitive rates. Add a starting credit score around 650, and you are likely stuck with double-digit APRs that compound interest costs. This creates a loop where borrowers continue paying high interest without access to better terms, simply because of the vehicle's age. However, not all lenders think this way. Many local and smaller credit unions will instead prioritize loan-to-value ratios, payment history, and membership status. In other words, they are more concerned with how much you owe relative to the car's value than the model year alone. With that shift in focus, let's move to why local credit unions can be your way out. Local credit unions often outperform big lenders because they are not bound to the same rigid age cutoffs. Their underwriting teams may weigh loan-to-value more heavily than the model year. If your LTV is healthy and your payment history is clean, you may receive a far better offer, including fixed rates that can sometimes fall under 5%, depending on market conditions and your profile. Membership criteria are typically broad employers, school alumni groups, counties, religious communities, or geographic areas. These institutions also tend to communicate clearly about what needs improvement, such as lowering your balance to hit a target LTV or providing additional income proof. Now that you know why local institutions help, let's quantify your position by calculating your LTV. Your loan-to-value is the ratio of what you owe to what the vehicle is currently worth. The formula is remaining balance divided by market value. For example, if you owe $18,000 and the car's market value is $15,000, your LTV is about 120%. Many credit unions prefer LTVs near or below 100%, though thresholds can vary. To estimate value, use multiple sources such as Kelley Blue Book, NADA, regional private party listings, and wholesale guides if you can access them. If your LTV is high, focus on reducing principal before applying. Even a few extra payments toward principal can move the ratio in your favor. With your LTV in hand, let's outline a concrete, step-by-step refinance plan. Begin by pulling your exact payoff amount from the current lender, then estimate the vehicle's market value using multiple sources. Calculate your LTV and define a target range based on credit union guidelines. If your LTV is too high, send extra principal payments to reduce it. Next, shortlist 3 to 5 local or employer-based credit unions that explicitly refinance older vehicles or prioritize LTV. Join the best fit by opening a share or savings account, which is typically required for membership. Prepare your documents, including identification, proof of income, proof of residence, insurance, and a payoff letter. Apply for pre-approval and request several rate and term scenarios, such as shorter terms for faster payoff. If you are declined, ask for the specific reasons and numerical thresholds so you can address them. Then, either finalize the refinance or pivot to an alternative while continuing to improve your profile. Speaking of lender types, let's compare national lenders with local credit unions. National lenders often use strict model year cutoffs that automatically reject older vehicles, and their underwriting may rely heavily on automated systems with limited exceptions. They also may provide minimal feedback when applications are denied. By contrast, local credit unions can be more flexible if the loan-to-value makes sense. Their teams are more likely to review files manually, provide actionable feedback on what needs to change, and offer competitive fixed rates with member benefits. With that context, let's examine several alternative paths if a traditional refinance still does not fit right now. This table outlines 3 paths. First, a credit union auto refinance offers the best potential rate if you meet loan-to-value and income requirements. Second, a debt consolidation loan can reduce overall interest costs when you have multiple high APR debts, even if it is not as low as a prime auto rate. Third, a share-secured loan uses your savings as collateral, offering relatively low rates while building credit. Consider which option aligns with your LTV and cash flow. Next, let's get practical about finding and vetting the right credit unions. Start with targeted searches that combine refinance, older vehicle, and LTV terminology. Review membership requirements to confirm you are eligible. Then, examine rate sheets and underwriting pages to see whether the credit union addresses age and LTV explicitly. A brief phone call can clarify policies quickly. Use the sample script provided to ask whether they refinance based on LTV, their maximum LTV and rate tiers, and the documentation required for pre-approval. With a short list in hand, let's test your understanding with a quick quiz. Quiz time. The question is, what is the primary application killer when trying to refinance an older vehicle? The options are A. The car's mileage alone. B. Being upside down on LTV. C. Not having an extended warranty. D. Not using a national lender. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Being upside down on LTV. When you owe more than the vehicle is worth, lenders have less collateral coverage, which often leads to denials or higher rates. Improving the ratio by paying down principal or negotiating payoff can make approval more likely. Now that we have clarified that, let's visualize a realistic timeline for completing a refinance. This timeline shows a typical flow. On days 0 to 1, you estimate value and get your payoff. During days 1 to 3, you join a credit union and open the required share or savings account. Between days 2 and 5, you gather documents and submit the application. Days 5 through 10 are commonly used for pre-approval, verifying income, and clearing conditions. Finally, around days 10 to 14, you receive final approval and funding, and your first payment to the new lender is generally due in week 3, or according to the new schedule. With the steps laid out, let's move to a second quiz to reinforce key strategy concepts. Here is the second quiz. The question is, to beat the 10-year rule, which focus is most effective? The options are A. Applying to more national lenders. B. Focusing on LTV and local credit unions. C. Trading the car immediately. D. Ignoring membership requirements. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Focusing on LTV and local credit unions. This is the core strategy that bypasses the rigid age cutoffs common at national lenders. By improving loan-to-value and targeting institutions that consider it, you maximize your chances of securing a significantly lower rate. Next, let's consolidate key takeaways and pro tips. The most effective refinances are well documented. Keep your payoff letter, valuation sources, and income proof organized. Focus extra payments on principal to improve loan-to-value rapidly. Compare 3 to 5 credit unions because their policies and rates vary. When applying, request multiple rate and term scenarios to tailor the payment and payoff speed. If you are declined, ask for specific thresholds and a suggested time frame to reapply. Before we conclude, let's cover an important disclaimer. This video is for educational purposes and is not financial, legal, or tax advice. Interest rates, underwriting policies, membership eligibility, and loan terms vary by institution, region, and over time. Always verify current details with each credit union or lender, and consider consulting a qualified professional for advice tailored to your situation. Your results will depend on your credit, income, collateral value, and overall profile. With that out of the way, let's wrap up with next steps you can take this week. To translate this into action, first pull your payoff, estimate the car's value, and compute your LTV. Next, shortlist 3 to 5 local credit unions and verify membership eligibility. Join the best fit, organize your documents, and request pre-approval. If your LTV is currently too high, Make targeted principal payments, and consider a temporary consolidation loan to reduce interest while you improve your profile. Revisit offers in 30 to 60 days if necessary. Now, let's close with a quick thank you and a call to action. Thank you for watching. If this video helped you, please like it, share it with someone paying a high auto APR, and subscribe for more practical money-saving strategies. I would love to hear which credit unions you found helpful and what rates you were offered, so share your experiences and questions in the comments. See you in the next one.